Okay, let's dive right in. What we've seen over the last several weeks isn't just another news cycle. It represents a fundamental shift in the international order we've known since the end of the Second World War. We're not just witnessing a trade dispute here. We are watching the very boundary between economic diplomacy and raw territorial ambition dissolve in real time. Our thesis today is simple. The Greenland Ultimatum is not some strange new event. It is the revival of a very specific and historically very effective 19th century American playbook for expansion, just updated for today's globalized world.
And this is the catalyst. On January 17th, the White House didn't issue a proposal, it issued a geopolitical ultimatum. The language is, well, it's completely unambiguous. It directly links punitive economic measures against allies to the forced sale of their sovereign territory. This isn't the language of modern diplomacy, it's the language of coercion, and it echoes a much older style of statecraft.
And look at how quickly this is escalating. The timeline is deliberately aggressive. A 10% tariff hit on February 1st, aimed squarely at key NATO allies, the UK, Germany, France, the Netherlands, and the Nordic countries. The entire mechanism is designed to inflict immediate economic pain, with a clear threat of more than doubling that pain to 25% by June 1st. Make no mistake, this is an economic siege, engineered to break European unity and drag Denmark to the table, whether they want to be there or not.
So here's how we're going to break this down. First, we'll dissect this historical playbook that's being dusted off. Then, we'll look at other historical precedents to show that this is a clear pattern. From there, we'll pivot to the real-world market impacts, what some are calling a stagflationary impulse, and see how institutional capital is already shifting. And we'll wrap up by considering what all this means for the price of sovereignty itself in this new fractured world. So, this is really the most crucial point to grasp. The strategy unfolding before us is not new. It's a direct, almost carbon copy application of a formula the United States used back in the late 19th century during its greatest period of expansion. If you want to understand what's likely to happen next, you absolutely have to understand the past. Let's be very clear on our terms. We are not talking about simple protectionism here. What we're seeing is trade coercion. This is the weaponization of market access. The goal is not to protect American jobs or industry. The goal is to inflict calculated economic damage on another state to force a political or, in this case, a territorial concession. The tariff is no longer a shield. It's being used as a battering ram.
Now this is where it gets truly fascinating. Look at this direct historical parallel. In the late 1800s, the U.S. carefully cultivated an economic dependency with the Kingdom of Hawaii, all centered around sugar. When Washington decided it wanted to force a political change, it didn't send the Navy. At least not at first. It simply passed the McKinley Tariff of 1890. This revoked Hawaii's duty-free access to the U.S. market and collapsed its economy, practically overnight. The crisis that followed led directly to the overthrow of the Hawaiian monarchy and eventually to annexation. The logic is identical to what we're seeing today. You weaponize trade to create a crisis that only a territorial concession can solve.
And when you break it down, you see this repeatable three-step process. It's a formula. Step 1, you create economic dependency. For Hawaii, it was the 1875 Reciprocity Treaty. For modern Europe, it's been decades of deep transatlantic trade and a reliance on the American consumer. Step 2, you engineer a crisis by suddenly pulling the rug out. The McKinley Tariff in 1890, the Greenland Tariff in 2026. And then Step 3, you frame annexation or a sale as the only possible solution to the very problem you just created. The message to the Hawaiians then, and to the Danes and Europeans now, is exactly the same. Your economic survival is conditional on our geopolitical demands.
And you know, Hawaii is not some isolated case. This pattern of using economic and geopolitical pressure to acquire territory has other key precedents. And that really reinforces the idea that this isn't an accident. It's the conscious revival of a specific strategy.
This table really lays out the pattern quite clearly. Whether you're talking about sugar and a naval base in Hawaii, a strategic harbor in the Danish West Indies during World War I, or now, rare earth elements and Arctic dominance in Greenland, the underlying logic is remarkably consistent. You identify a key resource or strategic location, you create a justification based on stability or national security, and then you apply a method of pressure to force the acquisition. That question mark for Greenland? Well, it's looking more and more like it will be filled in with tariff pressure, sale. And here is the most direct precedent, because it involves Denmark itself. Back in 1917, the U.S. bought the Danish West Indies, what we now call the U.S. Virgin Islands. Now, this was not some friendly real estate deal. It was done under immense geopolitical duress.
The US was worried about German U-boats using the harbors. Washington essentially told Copenhagen that if they didn't sell, the US might just have to seize the islands anyway to protect its own security interests. The lesson Denmark learned over a century ago is stark. When American security concerns meet imperial ambition, sovereignty becomes negotiable.
So why Greenland? And why now? Well, its value in the 21st century is multifaceted and, frankly, immense. Geopolitically, it is the strategic centerpiece of the Arctic, absolutely crucial for monitoring a resurgent Russia and an expanding China. Militarily, it hosts Pituffik space base, which is an irreplaceable part of our missile defense and early warning systems. Economically, it's a potential treasure trove of the critical minerals that are going to fuel the next century of technology. And finally, with climate change, the Arctic is transforming from an ice-choked barrier into a strategic global waterway, and Greenland stands as its gatekeeper.
And just to put the economic piece into perspective, let's look at just one category of its mineral wealth. Greenland has proven reserves of at least 1.5 million tons of rare earth elements. To be clear, this could be the second largest deposit in the entire world outside of China. For a Western world desperately trying to de-risk critical supply chains for everything from F-35s to electric cars, control over this single resource is a strategic imperative of the highest order.
So this brings us from the history and the geopolitics to the immediate, tangible impact on capital markets. This crisis has introduced a very specific and very dangerous dynamic into the global economy. It's forcing a fundamental realignment of how investors all over the world perceive risk.
You know, for most of last year, the market consensus, which JP Morgan sums up perfectly here, was to just dismiss all this talk as negotiating tactics. That has proven to be a profound miscalculation. The market has been violently forced to shift its thinking, from seeing this as just political noise to understanding it as a foundational threat to the entire global trading system. Risk is being repriced in real time as we speak.
The term that institutions are now using to describe this shock is a stagflationary impulse, and it's a particularly toxic combination for an economy. On one hand, the tariffs act as a direct tax, pushing up prices and fueling inflation. At the exact same time, the massive disruption and uncertainty freezes investment and drags on economic growth. Rising inflation plus slowing growth, that is the classic stagflationary environment, and it's one of the most difficult scenarios for any asset allocator to navigate.
And this isn't just theory. We are already seeing concrete actions from major institutional players. This chart shows data from Danish pension funds. In 2025, they sold off about 10 billion kroner, roughly 1.5 billion US dollars, worth of US Treasury bonds. But look at what they didn't sell. They're holding in American corporate bonds and stocks. This isn't a flight from America, Inc. It's a flight from American sovereign risk.
This quote from the chief strategist at PFA, one of Denmark's largest pension funds, this might be the single most important piece of market sentiment in the world right now. It perfectly captures this great decoupling that's happening. Global capital is now drawing a very sharp line between the dynamism of the US corporate sector and the perceived instability of its government policy. In other words, they're willing to bet on American companies, but they are no longer willing to bet on the full faith and credit of the US government itself.
So this new reality, it demands a new strategy. The old bedrock assumptions, like the US Treasury being the ultimate risk-free asset, are now being seriously questioned. We're seeing a new paradigm for geopolitical risk management emerge from the chaos.
And so, the consensus strategy that's taking shape across major institutions seems to be fourfold. First, broaden your diversification and reduce heavy concentration in U.S. sovereign debt. Second, increase international exposure, especially to markets that might be seen as more stable. Third, and this is critical in a stagflationary environment, increase your allocation to real assets, things like gold, commodities, and infrastructure, that can hedge against both inflation and political turmoil. And finally, a renewed focus on overall portfolio resiliency, using assets that are uncorrelated to the broad market swing.
To conclude, what we've analyzed today is more than just a crisis. It's a structural lesson for both capital markets and for nation-states.
The essential takeaway is this: the Greenland Ultimatum isn't an anomaly. It is the logical conclusion of a worldview that sees trade not as a tool for mutual benefit, but as a weapon of raw power. It revives an old playbook, where the economic siege of tariffs simply replaces the naval blockade of the past, and this forces a complete recalculation of risk, not just for portfolio managers, but for sovereign nations who now have to ask themselves what their political independence is worth when weighed against access to the global economy.
And that leaves us with one final and, I think, rather sobering question. For decades, we have all operated under a set of rules where, among allies at least, territorial integrity was considered sacred.
That assumption is now broken. So we have to ask ourselves, in a world where economic interdependence can be weaponized to demand the surrender of sovereign land, what is the true price of independence?